What's going on, guys? Welcome to one of Fortune 500. In this episode, I will explain to you what is profitability and which are the important metrics that we apply when we measure it. Profitability is one of the essential parts of the fundamental analysis. If you watched the previous episode, you know all about debt management, and by watching this episode, you will know profitability highlights also. In the next episode, I will present to you the last part of the fundamental analysis, which is valuation. By that, you will know what is fundamental analysis, how to do it, and why it's so important. Profitability is a measurement of efficiency. Profitability can tell the shareholders whether the company is able to sustain its position in the market and continue to grow. It is the extent to which a company earns a profit. There are two parts to a company's profitability: revenue and expenses. As such, a company is profitable if its revenue exceeds its expenses. The different metrics about profitability unravels whether the company is effective in turning the revenue into net income and cash flow, how well the company manages its assets by turning them to tools of making money, and how well the company generally makes effective business decisions by having small expenses relative to the company's size. If you're already lost in this big of a definition, just think to a profitability as a general efficiency of the company. In the next few minutes, I will present to you 4 metrics for that efficiency, and everything is gonna be clear in your heads. I promise. Just stay with me. I will begin with the first metric, which are 2 ratios that I'm gonna combine into one. That is margins. I'm talking about gross income and net income margins. They express what percentage of the total revenue goes to gross and net income. To get gross income margin, first we have to calculate gross income, which equals revenue minus costs of goods sold. In order for us to get what percentage of the revenue is that gross income, we have to do the following. Gross income divided by the revenue and multiply the result by 100 to get it in a percent. In WSJ, we have gross income margin and net income margin given for us without the need of manually do the calculation. So in terms of gross income margin, conEd has 36%. Net income margin for conEd is 10%. And we can calculate it in the same way as gross income margin. By knowing the net income, we divide net income by the revenue and multiply the result by 100 to get it in a percent. The averages for the industry is 66 and 10% respectively. So in terms of gross income margin, conEd falling behind substantially. In terms of net income margin, they are on point. But keep in mind what I said to you when we assessed generally the income statement. The company has better net income because of the non-operating profit. So that means that net income margin is not a result only from the company's business operations. So again, you have to put the metrics and numbers in context. The next 2 metrics are the favorite ones of Warren Buffett regarding the profitability. That is return on invested capital, ROIC, and return on equity, ROE. The average for ROE in utility sector is 10% and for ROIC 8%. And we want numbers above this. So we get ROE by dividing net income by shareholders' equity, and the result has to be multiplied by 100 to get it in a percent. ROE assess how well the company use and manage that equity to generate income. The net income of conEd is 1.6 billion, and when we divide that number by shareholders' equity, which is 20 billion, multiplied by 100, and we get 8%. Keep in mind that if the shareholders' equity is relatively low number, for example when the company has a lot of debt, that metric will go substantially high, but that will be artificial, not by effectiveness, but by debt dependence and low shareholders' equity. ROIC we get by subtracting the taxes from the net operating profit, so that is EBIT minus tax payments, and the result is divided by invested capital. That calculation is more complex because we first have to calculate the invested capital. Invested capital is the cash subtracted from the total assets. So we will get the ROIC by manual calculation. but keep in mind that you can get it by few clicks on the internet. But we will do the calculations manually in order for you to understand the ratio and its logic better. So first, EBIT is 2.6 billions. When we subtract the taxes, which are 500 millions from 2.6 billions, we get 2.1 billions of net operating profit after taxes. Now we have to calculate the invested capital, which we are gonna do by subtracting cash from total assets. This is 69 billions minus 1 billion, and we get 68 billions of invested capital. Now 2.1 divided by 68, and we get 0.31. If we multiply that by 100 to get it in a percent, we get 3.1% return on invested capital, which is really low number in comparison for the average of the industry, which is 8. But you don't have to put automatically conEd in frame of bad profitable company, because conEd is one of the biggest players regarding aggressive investments in green energy field, and it's just starting to make gains from that investments. The future is bright for the corporation because of the cash flow which is gonna be generated from EV plugs, green energy projects, and rate increases of their services. That's more important than the metric itself. Why? Because we invest for the future, not for the past. Now, the last metric regarding the profitability is asset turnover ratio. That ratio equals the revenue divided by total assets. The normal number for that metric in the industry is 0.25 to 0.5, but everything beyond 0.5 is extraordinarily good. So, we want to see a high number because that means that the company uses its assets effectively to generate more and more revenue. In order for us to get the metric for conEd, we divide the revenue, which is 15.6, by total assets, which is 69, and we get 0.22. It's a little bit lower than the optimum, but I will remind you once again that the last few years until the present moment, conEd invests really hard in physical assets, which is because of the green energy shift ambitions. Because of these investments and therefore accumulation of very big base of assets, that specific metric, asset turnover ratio, is lower than we would like to. But with that context, we can conclude that conEd is on point, because if it wasn't for that huge accumulation of assets, the ratio would be bigger. In conclusion, for the second fundamental significance, profitability, I will say this. conEdison is a really big player in investments for the future. Therefore, the company has more assets, more debt, and more expenses than we would like to. This is the answer to the question why the profitability metrics are a little bit deviated from the ideal range. But still, the corporation positions itself for a really bright future, and with the backup and protection from New York, the company will gain a lot from these past few years of aggressive investments. With the metrics, we assess where is the company in this present moment, but we always have to put the metrics in the context of future prospect. And in the case of conEd, the future looks blistering with opportunities. I will repeat once again that we invest for the future, not for the past. Well, this was all for this episode, guys. I hope that you got a lot of knowledge and value. If that's true, I will really appreciate if you hit the like button, subscribe to the channel, and leave a comment. But for now, have a wonderful week. I'm really looking forward to seeing you in the next episode. Bye bye for now, take care, and see ya!